we said, hey, I think that you could be making use of this real estate professional status. Not only that, but I think we could be depreciating your properties in a lot more strategic way. And through the combination of those two strategies, they were able to get a refund of $70,000 in 2025 for their 2024 taxes. All right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack. As always, it's an honor to be with you. It's an honor to have you watching and listening wherever you are. If you're in the car driving, thank you for listening either via Spotify or Apple. If you're on a computer or phone, maybe you're watching on YouTube, and we are so blessed to have you there. It's been a great pleasure of ours to bring the video content to YouTube and have so many people come and reach out and say that they've found us on YouTube. And a number of our latest clients have found us on YouTube and are finding significant tax savings this year and for years to come as a result of just stumbling upon our content, stumbling upon our videos. YouTube is the second largest search platform in the world, and so they just search tax strategy or real estate tax strategy, small business tax strategy, and somehow, some way our videos pop up and they're able to watch and listen. So if that's you, if you're joining us, thank you. If you're a regular listener, we love and honor you as well. Today, we're really going to be diving into some of the strategies that you should be aware of as we enter the end of the year. It is November 3rd at the time of the recording. This will probably be released just a few days later, and we have less than 60 days left of the year. And if you're like most people, those last 2 weeks of the year tend to be a lot slower and quieter and around family and friends, and the implementation is not always there during that time, which means that the urgency is even greater. Less than 60 days, you cut that down by 14 days, and now you're looking at like 45 days and just a month and a half to implement some of these strategies. So we want you to be aware of these, and these should be really things that you're looking towards, especially as you're in the real estate space, but there's also some things that are eligible for all types of business owners, all types of income earners. And so we're going to be jumping into that. If you get any sort of value out of this, please do us a favor and like and subscribe and even share it with a friend. That is how so many people are able to listen to us and watch us and find us, is through the efforts of people like you liking, commenting, subscribing, and even sharing as well. And I know that there's going to be some value here. So again, the 7 things that we have considered to be some of the biggest tax planning moves that you can make before year end. Let's jump in at number 1. This is for our real estate investors, our real estate professionals, is to solidify the real estate professional status. What is real estate professional status? It is the ability for you as somebody in the real estate space to write off your losses on real estate investment activities against your active income. So typically, real estate is a passive investment. And what does that mean? Is that it's categorized passively on your tax return, and unless you have passive income in the same or greater amount of the passive losses that you generate in real estate through things like depreciation and cost segregation, if you don't have that passive income, those things just get locked up. You have to carry forward your losses that you generate in real estate indefinitely. And so real estate professional status gives us the ability to turn what is typically a passive activity into an active activity, and thereby can be used to offset all of your active income, whether it's your income from your real estate activities or your spouse's income from their W-2 or their business, right? Real estate professional is one of the greatest strategies that we can apply for people who are in the real estate industry. We've had clients on clients get massive refunds through the use of real estate professional status. We have one client came to us at the beginning of this year, invested in multiple properties. The wife tends to stay at home and manage the investments, manage the properties, look for newer properties, get new tenants, help do the repairs that come in, and all of the things that are related to these properties and the investments that they hold. the husband is working a $300,000 job and paying the bills that way, but they also have these investments on the side. We said, hey, I think that you could be making use of this real estate professional status. Not only that, but I think we could be depreciating your properties in a lot more strategic way. And through the combination of those two strategies, they were able to get a refund of $70,000 in 2025 for their 2024 taxes. And those losses that were generated this year through the use of our tax strategy, we didn't use them all up. We're able to carry some of them forward. I think it's about $150,000, $160,000 worth of losses that are carried forward, which will just compound the number of tax savings that they get, and they'll be expecting another refund here in the beginning of the year. And since then, they've gone on to purchase another property. They're working diligently to give some of the money that they're getting back to causes that they care deeply about. And this is why we do it. This is the power of real estate professional status. And this is the power of planning ahead, right? Because you don't want to get to the year end and assume that you're a real estate professional, and then we ask you to collect all of the hours so we can verify it and you're 200 hours short. We need to meet that 750 hour requirements. And so if you're doing that ahead of the year and we now have 50 or 60 days left to make sure that we're meeting that, that's a lot of time to be focusing on real estate related activities. And you'll prioritize some of the projects that maybe you've been putting off or think you can do at the beginning of next year, because we need to get real estate professional status this year. Hey there, this is Chris. Thanks for listening to the Know Your Numbers podcast. Listen, if you are a real estate investor or business owner and you're set to cut a massive check to the IRS this year, you're going to want to hear this. Right now, I am taking on 4 new clients who want to save $400,000 or more in taxes. But the catch is this: what we are currently giving out as a complimentary tax assessment will soon be charging money for. So you only have a limited amount of time to get in the door. So the first 4 people who are willing to save $400,000 or more on taxes receive it completely free. Now is the time to plan for taxes, to save on taxes. And if you want to get in on this limited time offer, a free tax assessment with Better Books, you can do so by finding time on our calendar linked in the show notes. I look forward to meeting you and seeing how we can best partner with you for years to come. So what are some of the things that you can think about as it relates to those activities that qualify? It's activities related to the development or redevelopment, the construction or reconstruction, the acquisition, the conversion, the renting, the leasing, operating, managing, brokering. Those are all activities that qualify you as a real estate professional. So developing or redeveloping, maybe you're putting properties up. Constructing or reconstructing, maybe you're tearing them down and reconstructing. You're flipping, acquiring, converting, renting or leasing, right? You're the landlord and you are in charge of getting the tenants in and making sure they're paying on time and fixing the things that come up. Operating or managing, same thing. Maybe you are physically fixing it, or you're just working with the ins and outs and you're dealing with the finances and doing the bookkeeping, and then you're operating and managing it in that regard, and then brokering it. Maybe you're a real estate brokerage. All those activities would qualify for real estate related activities that will combine to make that 750 hours that can result in massive tax savings. You can offset your active income, whether it's your spouse's W-2, whether it's a business that you guys operate, whether it's other investments that you can have. This is one of the greatest strategies that we can use for people who are in the real estate industry. When I first got on to this business journey, it was things like this, the real estate professional status that I was aware of, but I realized that there were people out there that either weren't aware of it or they were aware of it, but they weren't sure they were getting the benefit of it. And it was these kinds of strategies that helped me realize that there was a big need out there for tax planning and making sure that we're getting everything in order and have these hours compiled to properly solidify these strategies that can save you tens of thousands of dollars. $70,000 refund our client got through the use of real estate professional status. You don't want to miss this. All right, so number 2, ensure short-term rental qualification. So maybe you don't have that 750 hours. Maybe you work a full-time job and there's just no way for you to qualify as a real estate professional. Are you left without hope? No, we can look at things like short-term rental qualifications, right? People call this the short-term rental loophole. People would say like the Augusta rule loophole, but it's all right there in the tax code. But the short-term rental loophole works very similarly to the real estate professional status, right? It gives you the ability to offset your active income with the losses that you generate on short-term rentals through the use of depreciation and the power of real estate. Ensure short-term rental qualification is met. So just like compiling and solidifying the real estate professional status, we want to make sure that we have all of our facts in order so that if we are going this route and claiming the short-term rental qualification and generating active losses through the use of our short-term rental, we got to make sure our facts are straight. So what are the facts that are most important? One, it's got to be a short-term rental. What does the tax code tell us is a short-term rental? 7 days or less is the average stay. So does that mean that you can rent out your property once for 7 days and then the rest of the days have it be a mid or long-term rental and you qualify for short-term rental status? No. They're going to want to see how many people stayed at your residence and how long did they stay there. You can have 14 days, you can have 2 days, you can have 5 days, you can have 3 days, but the average stay has to be 7 days or less, right? So you can have some people stay for 14 days. You just need to make sure that the rest are much less than 7 days so that they bring the average down. Okay, so you need to compile that information. That means you have to collect the number of stays that you had. And if you're using Airbnb or VRBO, they're going to have this information for you pretty easily. And then you have to divide the number of days that it was rented out versus the number of stays that you had. And that's your average. And if that's less than 7 days or less, you could possibly qualify. Now, that's one qualification that you have to meet. The second one is that you have to have 100 hours or more in that activity. And you have to be the primary contributor to that activity. So again, just like we kept the log of the real estate professional status and the amount of time that we're working in real estate related activities, we have to make sure that we get the 100 hours in our short-term rental in that one property to qualify as this short-term rental qualification. Use the losses on your short-term rental to offset some of your active income. Again, a great strategy. We've had clients use this, and as high-income business owners, high-income W-2 earners, we have a doctor client that used this strategy and last year was able to generate $110,000 worth of tax savings. It's unbelievable. It is a great strategy when applied correctly. If you're in the crosshairs of the IRS, you're going to hope that you listen to this podcast because these are the things that they're going to look for. They're going to want to know how many days it was rented, what was the average stay of each tenant, and where is the log for the number of hours that you, the one claiming active participation in this short-term rental activity, rented it out. Number 3 is consider cost segregation. All right, we talk endlessly about cost segregation here. Both of those people that I mentioned, $70,000 worth of a refund and $110,000 worth of taxes saved, both of them were able to use cost segregation in addition to those strategies that I mentioned above to solidify those tax savings, get that refund. And it's just amazing to see what we can do through the use of cost segregation. Why do I put it after those two? Because if we don't have the first two or either one of the first two, then this is a moot point. We don't need to focus on this because we won't qualify for the massive tax savings. And so I say this to help prevent you from going too quickly to the cost segregation engineers or buying a cost segregation study on your own before really knowing whether you're a real estate professional status, whether you have the short-term rental qualifications. But cost segregation in 2025 is a great strategy. President Trump and his cabinet and Congress have passed the One Big Beautiful Bill, which is now an act and now law. And as of January 20th, 2025, 100% bonus depreciation for all properties placed in service on that date or later. So that means that if you bought a property, short-term rental, long-term rental, in 2025 after Inauguration Day, January 20th, you can qualify for 100% bonus depreciation, which means that some assets that make up the entire building that you have, so I'm thinking windows, piping, doors, siding, those are qualified assets for 100% bonus depreciation. If you have $50,000 worth of assets in your one building that are 5-year and qualify for this bonus depreciation, you can get a $50,000 deduction in the first year rather than depreciating it over 27 and a half years. You can see, just thinking 27, you divide 50,000 by 27 or you divide 50,000 by 1. Which one's going to yield you the greater benefit? 50,000 divided by 1. And then you get these tax refunds like our clients, 70,000, 110,000, and then you can reinvest in another property and do it again next year, or you can give back to causes that you care about, and you can just multiply. That's what we're all about here at Better Books. We want to build long-lasting economic impact, to have long-lasting, eternal economic impact. And we do that by giving to causes that we care about, setting yourself up and your heirs and your beneficiaries up for a legacy that is going to change their lives. And if we're generating these tax savings and you're just going out and using this money on things that don't really matter, like, that's a different story. That's not something that excites us as much. Sure, we'll get you the tax savings, but if it's going to causes that you care about, whether it's to end human trafficking or to take care of single moms or do anything else in between, give to the poor, that's something that we care about. Or set your kids up for college or to get them on the right foot when they start adulthood. Like, those are things that we want to get behind and help you with. Number 4, the strategy that's going to help you arguably the most, but I put it here at number 4, is to get your books in order. Get your books in order. Man, you don't know how many times I meet with people and they're like, I haven't done bookkeeping this year. I haven't done it for the past 3 years. And I'm like, what? Where have you been? What have you been doing? But I understand. Man, running a business is challenging. It's stressful. There's all these emotions. The last thing people want to do is get their books in order and see where they're at financially, right? So many of the top business owners that we meet with, like, they've either are currently in or they've been in seasons where all decisions they make are based off of the bank balances. I got $10,000 in this bank account or $50,000 in this bank account. I can afford that $5,000 expense. That's not what we want. We want you to make decisions that are beneficial to the long-term health of your business and your personal life. And we do that by having a clear grasp on what we're generating. If we don't understand how much money we've made and what our expenses are and what our profit are, we have no idea what our tax bill is going to be. And so we need you to get your books in order, and we can definitely help you with that if that's something that you're struggling with or it stresses you out. But when you get your books in order, you can know your profit. And once you know your profit, you can run a tax projection. And once you know your tax projection, you can understand how much money are you going to owe to the IRS. And then you can also say, is there anything I can do about that? And there is certainly things that you can do about it, especially at this time. That's why we're putting this out here at the beginning of November, because now is the time to run those projections, to get a grip on where you're at financially and where you could be at from a tax standpoint. Man, I have a prospect that we're talking to, and he has never done anything like this. And he's been working with somebody who's keeping his books, but they weren't really communicating to him what it meant or how it was affecting him. And by the time his taxes ended up getting filed here in 2025, again, this is a client that he's looking to come onto our services because of the hurts that he's experienced. He's facing a 6-figure tax bill. I don't know how that's possible. I do not have that much money in the bank. And so how am I owing $100,000 when I only have $50,000 in the bank? These are the conversations I had, but that would have been completely avoided had we known what his profit was in November of 2024. Instead, we're talking about November 2025, and we're going to see if there's anything that we can do to help mitigate it, whether there were mistakes or missed opportunities that we can go back and apply. But like, you avoid those problems in the first place by addressing the issue here now. And we do that by getting our books in order, running tax projections, and then determining strategies that we can do, whether it's contributing to a retirement account or health savings account, or maybe accelerating expenses or deferring income, right? If we're doing this in our life, we have an expense that we have the option of spreading over the course of time over the next 12 months, or we can take it here in November and it'll be good for the next 12 months, be good for all of 2026. And because we have the cash, the Lord has provided. And so now we're going to accelerate that expense, and it's going to chip away massively at what we could owe on taxes. It's probably going to take us back down to the lower tax bracket, which is awesome. It's incredible. We rejoice in that because we have enough set aside. We're not taking on any debt, but now we're able to accelerate that expense. We'll have the services that we're paying for 12 months after that, and we'll be able to save on taxes. And then we'll come to the same point next year and say, hey, are there any expenses that we can accelerate? Maybe we can defer income. Maybe there's clients who have a bill due to us that we can wait until January to collect. We're doing this with one of our newer clients. Found us on YouTube, and they are expecting a pretty large payout from an investment that they're in. And the first strategy that we recommended is, hey, can we split this up over the course of 2 months, December and January? The payout was enough where if they received it all in one lump sum, it would bump them up to the highest tax bracket. But if we divide it up over just 2 months, December and January, doing that will bring them down from the highest tax bracket to like the 24% tax bracket. And the savings there, you're saving 13% of tax, right? Because you don't have to pay any at the highest tax bracket. Instead, you're paying it all at the 24% tax bracket, and it's multiplied. What you can do, it was $80,000 worth of taxes that we were able to save just by doing that one strategy, right? So that's something that you can do, but you can only come to that conclusion when your books are in order, you've run those projections, you know how much is at stake, and now it's, okay, what can we do to mitigate that? Number 5 is invest in equipment or vehicles. I talked about 100% bonus depreciation earlier. That is a strategy that is not just available to the real estate investor. That is available to people who invest in equipment, invest in vehicles, right? Many people are so well aware of the fact that you can offset a lot of your income by investing in a car, by investing in a car that is over a certain amount of weight, and using depreciation on the car is great. But if you're investing in that without knowing what your tax liability is or what the benefit is going to be, or whether that car even qualifies you for the strategy, then that's hopeless. You don't have the vision to help you achieve your goal. We're all for saving taxes, but if it's in an area where you maybe don't need a vehicle, I think I've shared on this. I have a buddy who I go to the gym with, and he's a well-supported real estate broker, and he's worked with his tax accountant for a long time. And at the beginning of this year, he had this nice custom-made truck that was all decked out for his brokerage. And then it wasn't soon after, at the end of the year, that I saw that he started pulling up in another nice truck, and it also looked like a custom truck. I wonder if he's making that investment because of tax savings, right? But if he could have, rather than having 2 trucks, both equally nice, neither one has a big issue, if he could have invested that money in say, equipment or other areas that might have benefited his real estate brokerage rather than getting a depreciating asset like a vehicle, wouldn't he want to do that? Man, I'm all for vehicles. If you're in need of a vehicle and it's something that can bring you down and it's something that you're considering and you're just not sure what the benefit will be, go for it. Do it. So long as you have the backing of a CPA. This is not tax advice for people that we don't speak directly to and advise on, but I don't want this to sound like I'm just saying never buy a vehicle. No, there is definitely a practical time where you want to be buying a vehicle. But if that money that you're investing, or even that debt that you're taking out on the vehicle, could be better used for something that will provide equally as much, or if not more, of a benefit from a tax perspective, why would you not do that? We know that there's great opportunities to invest in equipment that can yield significant tax savings. We have another client that we work closely with, this partner, who's able to give us large depreciation through a strategy that we've helped advise clients on. They're yielding $600,000 worth of depreciation benefits through this strategy. And that's going to save them well over $250,000 in taxes. They're high income earners, doctors, W-2s making almost $1 million in income every year. And we're able to yield $250,000 worth of tax savings through the use of this investment. And they're putting $60,000 down on it. That's an incredible payout. But if they were going to somebody and they said, okay, we have $60,000, we can probably buy a vehicle, they might save $10,000 in taxes, $20,000 in taxes, but they wouldn't save $240,000 in taxes, and it's still the same amount of money. So think wisely about it. Consider investing in these things, but do it in a way that is the most beneficial for you, not just now, not just decrease taxes now, but also in the future, right? Cars and vehicles depreciate. You don't need me to tell you that. As soon as you drive it off the lot, they're gone. They're done. They decrease in value. You will never get the same amount that you paid for it as soon as you drive it off the lot, unless you go back in time to 2020 when the world went crazy. Number 6, charitable contributions. This one was one of my favorites just because I love working with people that are charitably inclined. They want to give back. They want to support causes that they care about. And many people have gotten into business because of that. We've heard of people that are able to give 90% of their income away and live off of 10%. That's pretty cool. And they're able to do it through the use of business ownership. So how can you as a business owner contribute to charity and make sure that you're doing it in a way that is most beneficial? So this year, 60% of your AGI, adjusted gross income, can be gifted to charity. That's great. If you make $100,000, you can write off $60,000 so long as you gave those gifts to a qualifying charity, and now you're taxed on $40,000, right? Obviously, you no longer have the $60,000, but that money is going a lot further than it would if you were just spending $60,000 on yourself, right? It can go to feed orphans. It can go to end human trafficking. It can go to do any of these causes that you care about. Single moms, abolish abortion, right? These are causes that people are passionate about and that can be done through the use of charitable giving and receive a tax benefit on it. The Bible talks about wolves in sheep's clothing, and this one in particular, they were a client, and so we did some digging in them because we cared about them, and we wanted to make sure that what they were doing was in line with what they could do and what they should do from a tax perspective, and so we did. And when we do that, we first go to see, okay, what's their charitable status? What's their tax status? And this lady, minister, had on her website, Give Now, right? Just like you would if you had a charity or a church, what have you. Give Now option right there, and you can have the option to give directly to this person. However, we did some more digging, and there was no 501c3 set up in the name of this organization. So they could have the option to give, but the giving is not tax deductible, which for me, I'm thinking, why would you not set up a 501c3 as the person doing this? Probably because as a 501c3, you have to make your financial statements public, and they didn't want to do that because if they are who I think they are, the wolf in sheep clothing, their money is probably going to places that if the public saw, they wouldn't be too happy about it and would be far less likely to give money to. So my warning to people who want to give to charities, especially as it relates to taxes, is know that not all people have the right charitable status. It has to be a 501c3 to receive tax deduction. I shouldn't say 501c3 because churches technically aren't 501c3s, but you get a charitable donation. So just make sure that they are a legitimate charity, a legitimate organization that offers tax deductible gifts. And if they don't and you still want to give to them, so be it and good for you, but just know that you won't get the tax benefit of giving to charity. So you can set up private family foundations, donor advised funds. They multiply the impact that you can give. We've done an episode with Dan Kaminsky of Foundation Launch. His specialty is these private family foundations that you can set up, put funds into, then invest those funds, and then give a portion of that off every year. And same thing with donor advised funds. You can give out of the increase that you're receiving. Charitable remainder trust. These are creative ways that you can receive tax benefits and also multiply your impact, right? Because you can multiply the amount that you're investing. You have this seed that you can then grow through the use of real estate or investing in stock markets or small businesses or you name it. And then you can give even greater amounts than you would if it was just this $20,000 gift that you gave here in 2025. So those are great opportunities too, and they do come with tax benefits as well. They vary from private family foundation has differing tax rules than donor advised funds. Just to be aware before setting those up, you want to know about that. The final thing to consider as we enter year end and consider tax planning and want to make some moves before the end of the year, buying and selling investments timing. So this can be investing in real estate, this can be investing in oil and gas, this can be selling stocks and bonds and crypto that might be at a loss or even at a gain. You want to be aware of this. This is a huge strategy that might not seem that large, but it can make or break your tax liability. So oil and gas investments, the money has to be deposited into the syndication or the project that you're investing in before the end of the year. Oil and gas yields significant tax benefits. I love it because it provides a great tax benefit in the initial year, and then it can also yield a large return in future years. But in order to qualify for that significant tax benefit in the initial year, you have to invest in it before year end, 12/31, no exceptions, cutoff date. And to do that, you then get up to 70-80% of your initial investment written off against your income. It's great. It can yield significant tax savings and can be used to offset multiple different types of income. Make sure that you qualify and make sure that your funds are deposited before year end. Investing in real estate, maybe you are doing what we call a lazy man's 1031 and you sold a property at the beginning of the year and your intention was to buy a property before year end. You got to do it before year end. Got to do it before year end. If you don't know what I'm talking about, we sometimes advise people who don't want to do a 1031 exchange or an opportunity zone or some of the other strategies that we can implement through tax strategy and save on capital gains taxes, some people don't want to do those. And so they'll sell a property and then they'll hold on to their profits. And then their intent is to buy another property and cost segregate that before year end. But it's got to be ready to use before year end, and you got to invest in it before year end. So those are things that you want to be aware of. The strategy is buying and selling investments timing. Oil and gas, real estate, both of those would fall under this. And then harvesting losses, right? We know many people are aware of this idea that you can harvest losses and offset some of the capital gains that you might have for the year, right? So if you have a lot of stock ownership that is in a loss position and you sold other stocks, or maybe you want to sell some stocks that are in a gain, or maybe you sold real estate that was in a gain and now you have these capital gains, selling the stocks that are in a loss position and offsetting the gain with the losses is a great strategy. That's got to be done before year end. And you got to be aware of what's known as wash sale rules. Wash sale rules. It hurts people upon people year after year. You can't sell a stock on December 30th and then buy it back on January 2nd. To avoid that, the IRS and the legislators have put into law the fact that there's wash sale rules. Can't do that. You can't sell one day in year one and then buy it back a couple of days later in year two and then have a lower basis, a lower ownership, and then receive all the gains, right? So to avoid that from happening, they've implemented a law that says if you buy it back before 30 days after you sold it, wash sale rules apply and you no longer get the losses that you initially received. And so this comes into huge conversation. This comes to have a huge impact when we're talking about day traders, right? People are trading. You can offset your income with losses that you receive on day trading. But if you buy it back within a few days, that's a wash sale. And you no longer qualify for those losses. We are meeting with a prospect who is facing $400,000 in taxes because he wasn't aware of these wash sale rules. And he bought securities back before the 30 days were up, and those losses no longer qualify. So timing of your investments, buying or selling, is huge and has the opportunity, the ability to make or break your entire tax strategy for the year. These are 7 things that you should do before year end. 7 tax planning tips that you should be aware of and start implementing before year end. If you're wondering or worried or concerned about any way that you can implement this, or maybe you're just curious about how this could apply to you, reach out to us today. You can find our calendar in the show notes. You can visit our website, betterbooksaccounting.co, and we'd love to see if our services are a good fit for you. Until next time, God bless you and keep moving forward.